Hi everyone, welcome to Foxon Media Digital. My name's Amy and today I'm joined by Ed Smith, who's the Co-Chief Investment Officer at Rathbone Brothers. So hi Ed, it's great to have you on the channel.
Hello Amy.
Yeah, thanks for joining. Of course, you're taking part in the Summit for Wealth Management in May, so we wanted to put a little spotlight on you and see a bit about what you're doing in your role before the event. So just to get started, before we dive into some specific topics, would you mind telling us a little bit about yourself and a bit about what your role is?
Yeah, sure. So as Co-Chief Investment Officer at Rathbones, my fellow co-CIO and I lead a department of 48 full-time analysts, strategists, economists, data technicians, ESG specialists. And we're responsible for the investment process and its evolution. So my background is as an economist and in asset allocation. So I've got day-to-day responsibilities for economics and asset allocation, fixed income and currency, and risk modeling functions. And I'm also the main spokesperson for the firm in external investment matters, which I guess is why I'm in front of you today.
Fantastic. Well, I'm sure you're very busy because there's a lot going on in the industry right now, when it comes to inflation, ESG, and of course data. So just to narrow it down a little bit and go into those one by one, where are we now this year? Obviously, it's the start of 2023. What are you focusing on and what is inflation doing when it comes to your work?
Yeah, so we think the outlook for this year is really going to come down to the answer to two questions. Will the global economy fall into recession, and will central bankers stop for tightening policy? And that second question is really conditioned on the outlook for global inflation. So we're doing a lot of work there. We think there's compelling evidence that global core goods inflation is falling back down to zero. Those supply chain disruptions, they've largely normalized. Order backlogs cleared, shipping costs plunged. Some categories of goods are even in outright deflation globally. Food added a lot to inflation last year. That follows agricultural commodity prices just with a 9-month delay. Given what's happened to them, food prices are likely to contribute much, much less. And similarly, energy prices are going to detract from consumer price inflation this year globally. But a lot must go right, and this is the sort of the thing that's keeping us up at night. A lot must go right for inflation to fade back down to central banks' targets as rapidly as current market levels suggest. And there's mixed evidence in some service sector inflation. Some services inflation rates are still registering new highs. Wage inflation is likely to fall back. We've got some leading indicators there, but those indicators are not suggesting it's going to drop back to levels consistent with that 2% inflation target. So we expect sharply lower inflation this year, but the risks are skewed to it staying a little higher than the market might be comfortable with.
And is that outlook the same globally, or is it different in different regions? Because of course the UK has its own challenges. So what are we like when it comes to the UK market specifically?
Yeah, so I mean that applies globally, but in the UK there are some unique risks, and we think that the risk of inflation falling back only slowly is most significant here. So again, we do expect that headline rate to drop sharply, but to remain well above the Bank of England's 2% target into 2024. So what are some of those unique risks? The huge and continued rise in the number of people out of work due to long-term sickness. That's a particular problem. It's in stark contrast to every other advanced economy since the end of the pandemic. And that squeezes the supply of labour, right, and therefore gives those in work more bargaining power over future wages. Another concerning development in the UK specifically, and less so elsewhere, is what we're seeing in inflation expectations. There's more evidence that the current period of super high inflation is starting to influence firms and households' longer term plans. And that can become a bit of a self-fulfilling prophecy. In the next year, for example, the Bank of England's decision maker panel survey still shows firms intend to increase prices by more than 6%, which is still very high. And then also the pound has been very weak, and that takes time to fully pass through. So all those, that makes imports more expensive, and that takes time to fully pass through into consumer prices. And this is another source of upward pressure.
Yeah, and before we move on to look about the rest of the world, what will the energy market look like? I know that we're getting past winter. Interest rates are sort of steadying, but we had a very cold winter, and as we come out of that, what will that mean for commodity markets?
Yeah, well, let's start with continental Europe, because that was where the risks of like profound energy shortages and the rationing of gas and things like that was most at risk. Europe actually had an unusually warm winter, and it did a superb job of finding gas from elsewhere, to replace the Russian gas that it no longer had access to. And coupled with that really warm winter, just look at the sort of snowless ski resorts as examples of that. That allowed those gas storage supplies in Europe to be really, to continue to be full. And that puts downward pressure on prices, certainly gives European consumers a lot more breathing room. The UK was at less risk of energy rationing for sure, and so our colder winter isn't the sort of worry that it would have been if it was replicated elsewhere in Europe. Energy prices are coming back down. That's important because government subsidies in the UK were set to roll off from April, which could have led to another surge in energy prices for the consumer. But the end of winter isn't upon us yet. It's definitely been chilly this week. It is still a risk.
Yeah, it's generally promising overall, so that's good news. And elsewhere in the world, obviously China's economy is reopening. So what does that mean for the world and for global inflation?
Yeah. Maybe let's continue the talk about energy prices, because I think a lot of people are worried that if China's economy really reopens very successfully, that's a lot more demand for transport, for energy in general. And commodity strategists reckon that a successful Chinese reopening would add about 1 million barrels per day of oil equivalent to demand. That's about 1% of oil, of global oil demand. And that's quite significant, but it perhaps only adds about $5 to $10 to the price of oil. And now, of course, oil is very hard to predict. So the outcome is, of course, there's uncertainty around that sort of base case of extra $5 to $10. But we shouldn't necessarily assume a base case that means that sort of holds that Chinese reopening causes global inflation to surge due to energy. Chinese producer prices, the prices that influence export prices, the prices at the factory gate, the rest of the world pays for China's goods. They're at the moment falling. They're in deflation. Back the year on year, producer price inflation has been negative 3 months in a row. So it's important to note that starting point. And looking ahead, there is ample capacity and inventory at Chinese manufacturers. And we expect a Western recession this year, and that means lower demand for these consumer goods in particular. And these things put downward pressure on Chinese export prices. Now, within China, the final sort of aspect of inflation to consider, domestic inflation is likely to rise as a recovery gets underway. That may put some pressure on the goods that China imports from the West. But there are good reasons to think that those price pressures won't surge to the same extent as in many other economies when they reopened post-COVID. These include the fact that actually Chinese goods only account for, consumer goods only account for about, consumer goods are a greater proportion of China's inflation basket, and it's consumer services that get the bulk of the post-lockdown demand. That's where the inflation pressures really come after the reopening. And China's highly flexible migrant labour force, which helps iron out labour supply of shortages from sector to sector, region to region, in a fashion that never happens in the West, is really important to note. So, yeah, to sum all that up, successful Chinese reopening will put some upward pressure on global inflation, but probably not as much as some people fear.
Yeah, great. Thank you for that insight. And in light of all these risks then and things that are going on in the world, what can wealth managers be doing to help clients navigate the risks and sort of create resilient portfolios for themselves?
Yeah, well, there's a few things that wealth managers can do for their clients. I'll perhaps give you three of the things that we're thinking about. We know that when inflation falls below around 4 to 5%, bonds tend to be an effective portfolio diversifier if equities is the core of your portfolio. Now, we do expect inflation to fall below that threshold, even though we think there's risks that it could get a little stuck, not too far below that. But to guard against the risks that it stays above that, which are not insignificant, uh, wealth managers need to ensure a broader array of diversifying assets in their portfolios. So actively managed strategies such as trend following funds or ones that benefit from higher macroeconomic volatility, they've been working well and should continue to feature in portfolios. Second, as inflation falls back, paradoxically, it actually becomes harder for firms, for companies to pass on costs and remain positive and maintain positive nominal earnings growth, especially if we're heading into recession. So when it comes to stock picking, close scrutiny of pricing power becomes even more important this year. Look for those strong margins, those consistent markers of stable profitability. And third, if inflation does get stuck above 2 to 3%, bond yields could rise again. And that means that we need to remain careful of assets that are highly sensitive to changes in bond yields. And in equity markets, that's particularly speculative high growth companies. And it's really important to note that the period from 2017 to 2022 was really highly unusual, right? We're all human. We have a tendency to think the recent past is the norm. But that period from 2017 to 22 was highly unusual. We look at data going back to 1930, and these types of high growth companies don't usually outperform more boring value companies. So again, a way to guard against inflation is to be a bit more boring in your stock picking.
Some great advice there. Thank you for those 3 points. I think those are some excellent ways to close the interview. But as a last point, what are your hopes for the next 12 months? What are you prioritizing then in light of all this?
Well, I mean, our hopes is that we do get a path to a new bull market becoming very apparent at some point this year. We've got to navigate a sort of pause to central bank tightening and the beginning of a recession first. But assuming that central banks don't need to continue to tighten, and assuming that the recession is relatively mild, we are preparing ourselves for going back overweight, higher risk, more cyclical assets. So we're building checklists about what we need to see in order to turn more bullish and readying the trades. Now, it may be that we don't hit that button until the end of the year, but I'm hopeful that at some point this year we are back to the beginning of a new, more positive cycle.
That's great. Well, of course, you'll be speaking at the Summit for Wealth Management on the 9th of May. So I know that's relatively soon, but I guess, we'll see where we are then, see where you're at in your journey when it comes to how this year is panning out. So for now, it's been a pleasure having you on the channel. So thanks so much for giving your insight and a really good in-depth analysis of where we are in the economy. And we'll speak with you soon.
Oh, it's my pleasure, Amy. Thanks. Looking forward
Thanks,
to it.
And thanks everyone for watching. Don't forget to follow our YouTube channel for more content on the challenges and opportunities in asset management, wealth management, and ESG. And don't forget to give this interview a thumbs up and hit the subscribe button.